It was a tiring week for the domestic equity market as the benchmark index closed at 33,439 points, marking a week-on-week correction of 3.4%, extending that correction to a year-to-date decline of 17.6%. The exit of BNPM from the PTI-led coalition government, coupled with a lifeless and dull federal budget announcement, left the investors unhappy. The volumes did improve week on week. The traded value declined by 15% week over week, which was further dented by a 1.5 depreciation in the rupee week over week. The foreigners recorded net outflows worth USD 4.8 million for the entire week versus outflows of USD 7.7 million in the previous week, 2-week cumulative outflows to USD 12.5 million. Let's look at the sectors that contributed to the week over week correction. A look at the sectors that contributed to the week-over-week correction included pharmaceuticals. Excitement over potential COVID-related drugs kept the pharmaceutical sector upbeat as it closed up by 0.1%. Owing to the oversupply, the oil and gas sector marked week-over-week declines of 1.1%. Other sectors that marked corrections on the back of political noise and a dull and lifeless budget included banks, fertilizers, power, and cements, which all declined 3.3%, 4.7%, 4.4%, 5.5% on a week-on-week basis. Looking ahead, volatility is expected to persist in the market, so would recommend you sell on strength or buy on dips. And please stay away from speculative stocks, only eye blue chip stocks, particularly the big 5 banks, or if you're talking about power, then go for HUPCO. You can also accumulate Pakistan Petroleum and oil and gas, keeping in mind that eventually the lockdown will come to a pass, so you could keep averaging your portfolio, your holdings in that aspect. Let's switch gears and have a look at what's happened in the regional markets. The Philippines and the Kuala Lumpur Composite Index marked a week-over-week decline of 2.5%, while Taiwan, Korean, Shanghai, Bombay, and Indonesian Jakarta Exchange rallied by 1.1, 0.4, 1.7, 2.7, and 1.3% week-over-week, respectively. With regards to the COVID-19 situation, the number of confirmed cases in Pakistan are just below 117,000, while the number of cases reported in the previous 24 hours are at 6,600. Deaths in the previous 24 hours are at 153, while recoveries in the previous 24 hours are a little over 2,100, taking the recoveries to death ratio to around 13.9. Though selected areas have come under lockdown, we still expect the number of cases to go up in the coming weeks. Let's switch gears and have a look at what's happened in the FX market. The rupee closed at 166.6 against the dollar as on 19 June versus 164.2 in the previous week, marking a week-over-week depreciation of 1.4%, extending that depreciation to 7.6% year-to-date. With regards to reserves, the foreign exchange reserves as on 12 June came in at 16.8 billion USD versus USD 16.7 billion reported on 5th June, marking a week-over-week improvement of 0.4% owing to improved remittance flows from UK, USA, and Oman, while marking a year-to-date decline of 6.4%. The year-to-date decline of 6.4% could largely be attributed to panic selling from the equities and bond markets, where March marked a major outflow of USD 1.9 billion owing to foreign outflows from Treasury bills, equities, and PIBs. It is around the same time that upward pressure was put on the rupee as it reached a high of 167 during March. Switching gears and having a look at the US Treasury yield curves, so rates for the shorter tenor government papers are at 0.17 versus the longer tenor ones, which are not too far apart. While the equities and the credit markets have seen some improvement, credits are incredibly tight, while major indices have rallied and the Nasdaq is on fire. The bond market, however, is still screaming as if it's the end of the world. As you can see that the rates for the longer tenor government papers are pretty much the same as that of a shorter tenor one, a 6-month one. So this means that the recovery within the rates market has not yet been priced, which could mean that it's a tremendous buying opportunity because many investors expect there to be a deflation forever and they're not expecting the Fed to actually be able to stimulate and the economy to restart in a positive way. Moving on to the gold market. Gold, which is often used as a safe store of value during times of political and financial uncertainty, closed the week at USD 1743.5 per ounce, depicting a week-over-week improvement of 0.7%. Macro uncertainty, lower interest rates, and accommodative central banks should remain long-term supports for the gold. Moving on to the oil market. The WTI crude closed at USD 39.8 per barrel, marking a week-over-week improvement of 9.6%, while the Brent crude closed at USD 42.2 per barrel, marking an improvement of 8.9% week-over-week, in line with the WTI. Be sure to share the information if you thought it was useful. Share, subscribe, and hit the bell icon so you remain updated with the latest market developments. Thank you for your time.